The current economic situation, with increasing inflation, rising interest rates, and the looming threat of a recession, is causing widespread concern regarding investments, careers, and future financial stability. However, contrary to popular belief, periods of economic slowdown actually represent a golden opportunity to accumulate wealth. This is a unique, once-in-decades chance to get rich. Typically, wealthy individuals do not complain about recessions. When the economy goes down, their incomes often go up. Warren Buffett himself pointed out that the rich, like him, benefit from these periods. 400 wealthiest people in the United States have seen their wealth increase dramatically, from $93 billion in 1982 to $2.4 trillion in 2022. This represents a 25-fold increase in their fortune over 40 years. Hence, it is advised not to fear recessions or stock market downturns. He considers these times as opportunities to buy stocks at low prices. The history of the stock market shows that each crash is followed by an even stronger recovery. Wise investment decisions can help build wealth even in a challenging economic climate. For the upcoming year, it is crucial to recognize that periods of economic slowdown can lead to unemployment, salary cuts, and a decrease in asset values. And in this video, I will give you Buffett's 8 tips for becoming rich next year. 1. See the crisis as an opportunity. Warren Buffett has a unique way of looking at recessions and economic crises. Where many see barriers, he sees opportunities. To him, a market downturn is like a sale period for stocks. Instead of worrying about falling prices, he sees them as a chance to buy quality shares at a reduced price. For example, during the financial crisis of 2008, while most investors were in a panic and selling their shares, Buffett chose to invest. He injected billions of dollars into companies like Goldman Sachs and General Electric, which were struggling at the time and whose stocks were undervalued. He knew that these companies had solid foundations and that they would recover over time. This strategy proved profitable when the economy recovered, and the value of these companies soared, bringing substantial profits to Buffett. What he teaches us here is the ability to look beyond the immediate fear of the market. We are not saying to go out and buy just any stock because there's a crisis. What is necessary is to choose carefully. It's essential to look for companies that have a solid foundation, good management, and long-term growth potential. This means studying the company, understanding its business model, and being convinced of its ability to recover from tough times. Only after a thorough evaluation should you consider investing, even if the prices seem attractive. 2. Invest in essential and non-cyclical sectors. When Warren Buffett considers his investments during times of crisis, he often turns to essential and non-cyclical sectors. These are sectors that provide products or services that people consistently need, regardless of the state of the economy. For example, food is a key sector because, recession or not, people need to eat. Likewise, basic consumer goods such as soap, toilet paper, and toothpaste remain in demand because they are part of daily necessities. Healthcare is another critical area. Medical services and pharmaceutical products remain necessary as health needs persist even in times of economic crisis. This is why Buffett has invested in companies like Coca-Cola and Procter & Gamble. Coca-Cola, with its beverages regularly consumed by a wide audience, and Procter & Gamble, known for its many everyday consumer products, represent typical investments in non-cyclical sectors. These companies tend to remain stable and resilient even during recessions because the demand for their products does not fluctuate as much as in other sectors. Thus, by choosing to place his money in these types of companies, Buffett not only ensures the resilience of his investment during tough times, but also their ability to generate stable returns over the long term. 3. Invest in bonds and fixed income securities. Warren Buffett, known for his astute stock investments, has also recognized the value of bonds and fixed income securities, especially in volatile or overvalued market contexts. Bonds and fixed income securities are like loans you make to a company or government in exchange for regular interest. Unlike stocks, where returns depend on the company's performance, bonds offer more predictable and stable returns during times when stock markets are uncertain or seem too expensive. Buffett has often chosen to invest in these safer and more stable securities. For example, during the 2008 financial crisis, when the stock market was extremely unstable, he increased his investments in government bonds. This allowed him to protect part of his portfolio from market turbulence while generating stable income. This aspect of Buffett's investment strategy shows his balanced approach and caution. Even an investor primarily focused on stocks can recognize the importance of diversification and the value of the security offered by bonds and fixed income securities in times of economic uncertainty. By including these assets in his portfolio, he ensures not only some stability during stock market volatility, but also a constant income stream, which is particularly valuable in periods of economic slowdown. 4. Focus on value stocks. During recession periods like the one we are experiencing now, it is crucial to focus on value stocks. In simple terms, this means looking for stocks that are selling at a price lower than what they are really worth. Imagine finding a high-quality item on sale in a store. This is somewhat how Buffett approaches stock market investment. He looks for solid companies whose shares are undervalued by the market for one reason or another. A concrete example is his investment in American Express in the 1960s. At that time, the company was involved in a financial scandal, leading to a significant drop in its stock price. However, Buffett saw that the company's fundamentals were strong and that the scandal was a temporary problem. He therefore invested heavily in American Express, convinced that the company would recover, and that's exactly what happened. The stock value increased significantly afterward, generating huge profits for Buffett. Seeking out value stocks shows how Buffett uses thorough analysis to find rare gems in the stock market. He does not follow trends or rumors, but focuses instead on the real data of the company and its long-term potential. This means that during a crisis, it's better to focus on searching for undervalued stocks of solid companies. These stocks are selling at a price lower than their real value. For ordinary investors, this implies not just following general panic or market trends, but doing in-depth research. It involves looking for companies with strong fundamentals, such as solid management, a good profit history, and a robust business model, but whose stocks have been temporarily depreciated due to the crisis. 5. The importance of liquidity. Liquidity in investment strategy, especially during a crisis, is a central aspect of Warren Buffett's approach. In simple terms, liquidity means having cash available or ready to be used at any time. During a crisis, the prices of stocks and other assets can drop significantly, offering buying opportunities at very favorable prices. Having available liquidity allows an investor like Buffett to seize these opportunities without delay. For example, in 2008, many quality companies and stocks were selling at extremely low prices due to market panic. Buffett, having kept a significant cash reserve, was in an ideal position to invest. He was able to acquire shares in leading companies at reduced prices, which proved to be a very profitable decision when the market eventually recovered. A cash reserve is essential to act quickly in times of uncertainty, instead of being a spectator or having to sell other assets at a loss to free up funds. Buffett ensures he always has enough cash available to take advantage of good deals the market may offer, especially when they arise unexpectedly. 6. Your psychology. The psychology of the investor plays a crucial role in stock market success, and no one knows this better than Warren Buffett. One of the most important aspects of his investment strategy is his ability to keep his composure and not give in to panic, even when markets are in turmoil. Buffett understands that emotions like fear and greed can lead investors to make rash decisions, often at the worst possible time. Instead of reacting impulsively to the highs and lows of the market, he remains faithful to his investment principles, focusing on the long-term quality of the companies in which he invests. A striking example of this approach was observed during the financial crisis of 2008. While many investors panicked and sold their shares, fearing an even greater market drop, Buffett took a different approach. He kept his calm and looked for opportunities in the chaos. Instead of selling, he invested in quality companies whose prices had fallen, convinced of their long-term growth potential. This ability to remain stoic and adhere to a well-thought-out strategy, even in times of crisis, is what often distinguishes successful investors from others. Thus, the key to success in the stock market is not only knowing what to buy, but also knowing how to manage your emotions. By avoiding hasty decisions based on fear or euphoria, and focusing instead on fundamentals and long-term value, one can better navigate the sometimes turbulent waters of the financial market. Buffett demonstrates by example that self-control and discipline are essential components for succeeding as an investor. 7. Be cautious of debt. Warren is well known for his caution towards investments in companies with high levels of debt, especially during times of economic crisis. His wariness of debt stems from the understanding that in times of crisis, companies with significant indebtedness may struggle to repay their debts, which can compromise their stability and growth potential. Buffett prefers companies with strong balance sheets and prudent debt management, making them more resilient during tough economic periods. For example, during the financial crisis of 2008, Buffett avoided investing in companies heavily laden with debt, favoring those with a sound financial structure. This helped to protect his investment portfolio from the worst effects of the crisis. 8. Never stop learning. A fundamental aspect of Warren Buffett's investment strategy is his unwavering commitment to continuous learning. Buffett devotes a significant portion of his time to reading annual reports, investment books, and newspapers, thus keeping himself constantly informed about market trends and economic developments. This thirst for knowledge is essential for making informed and wise investment decisions. He firmly believes that enriching one's knowledge is the key to succeeding as an investor. This approach of perpetual learning has been a cornerstone of his success. For those looking to follow in Buffett's footsteps, it is crucial to dedicate time to financial education and meticulous market analysis. This is all the more valuable in today's complex and rapidly changing financial world. And today, I have a special gift for you, a free book titled Financial Freedom for the Rest of Us, written by a millionaire. This book is a practical guide to achieving financial independence and is now available for free in the description below. Don't miss out on this opportunity to learn from a successful millionaire's experiences and advice. Download it now and start your journey to financial freedom. Thanks for watching.